Hello, my name is Troy White, and I'm here to talk to you about finance and investments. I'm with the firm Hoodoo Financial. We're a registered investment advisory specializing in underserved community. African Americans mostly are my client base. A little bit about myself. I have been in the financial services industry since approximately 1999. You can look at my resume to see exactly when. I think it might have been a little bit before that. Look me up on LinkedIn if you want to view my resume. Got a degree in business administration. Actually, my bachelor's in business management. Master's degree in financial analysis and in investment management. Um, Professional certifications and specialized training in treasury management, personalized financial planning, blockchain, user, uh, so on and so forth. A lot of all my specialization in training and education is in finance and investment. Um, why am I talking to you? Basically, I'm here to tell you about tips on finance and investment, and overall to let you know about the new technological advancements that we are bringing to you. And basically, because the folks who I'm speaking to are new types of investors, you are a new client. You typically are not served by the industry at large, and with the new technology, the new direction of laws and finance and investment, um, you have a need, and some people don't know they have a need, and most people have no idea what to do and where to receive that help. So that's why I'm talking to you. We have the tools to tell you about that will benefit you, and the techniques that really the techniques have been around forever. There's not much new there, except that there are new technological tools to help you use those strategies and those techniques. And so that's what I'm pretty much telling you about. So today, what am I talking about? Today I want to talk about how you can use your retirement account to invest in real estate. How we use retirement accounts for real estate investing. It's a lot of ways, and only a couple of ways. So, sort of covering that, right? It's a lot of ways to use a couple of methods. That's sort of how it works. All right. Primarily, to invest in real estate, if you want to use to invest in investment properties using your retirement account, you're going to be using self-directed IRAs, or I will call them self-directed retirement accounts. Self-directed means, well, basically, uh, I'll tell you what it theoretically means and what it actually is, right? So theoretically, it means you're going to direct the investments on your own. You're going to control it. And self-directed, basically, I'm gonna give you a more simple explanation, a more realistic explanation. And what it is that historically, the financial services firms that that you use for your 401k and your IRA, they're doing it the simple way, in that they're only focusing on your activity as it relates to stocks, bonds, and mutual funds and ETFs. Anything outside of that, they don't want to bother with, because it requires a different skill set, different technologies, and different office infrastructure somewhat. So fundamentally, they don't really involve themselves with self-directed IRAs. And that's because of what goes in the IRA is a little more complicated than they are interested in getting. And for average investors, they aren't even aware of what you can do in these accounts. And so these larger firms don't even bother with it. But self-directed IRAs have been around forever. All right. Self-directed IRAs fundamentally are retirement accounts that will allow you to hold real estate assets in them. I'm starting and saying real estate assets because that's what we're talking about. However, I wouldn't be serving you right if I didn't give you a more complete picture. So it's not for real estate, it's for alternative assets. So at our firm, you can invest in alternative assets, which include real estate inside self-directed accounts. So we allow you to open self-directed accounts. Those are usually IRAs. We also have self-directed 401ks. We'd be here all day if I was telling you how you would use those and why you would use those. But for the common individual, you're going to use a self-directed IRA, individual retirement account. So in self-directed IRAs, I'll give you some 4 instances. Let's say that you see you're interested in owning an apartment building. Well, as you know, apartment buildings are more expensive than your common single family residence. However, well, I won't say however. Let's just say there's an expensive property and you need a down payment for this property. Well, you can use your retirement funds because just look at your account statements. Your retirement account has more in it than your traditional investment account. Your non-retirement investment account is less than your retirement account. I mean, if you're like most people in America, right? So using your retirement funds allows you to access more capital to invest in a bigger property. So then we got to touch on, that's just the down payment. Now, so if you were investing in real estate inside your retirement account, that would be a self-directed IRA. Now, we're only using your funds inside of your account as the down payment, theoretically, because remember, in real estate investing at all times, we want to use the most of other people's money as possible. So that means we're going to use credit and leverage. And we need to discuss credit and leverage, equity and leverage, and how that interacts with your retirement accounts. And we're going to touch the retirement account and leverage. Okay, so credit and leverage. So the benefit of investing in real estate in general is that for a down payment, you can access, meaning you can acquire the property and control the property, this large asset, this real estate asset. So what I mean is, for $1 million property, if I only put 10% down, that's 100,000, but I still get the $1 million property. And for this $1 million property, let's assume it's got 10 units, and those individuals who are renting will be paying the mortgage. So they are buying this property for me that I only put a down payment. So with the self-directed IRA, the portion that I want to focus on now is that down payment. So that 100,000 down payment on that million property that we were talking about. Even though we actually, let's do more accurate numbers, because for $1 million property, and it's an investment property, you're going to have to put 25% down. So that's $250,000. So it's not unheard of for individuals to have $250,000 in their retirement account. So let's use that example. So you put 250,000 down. That money was in your retirement. You basically recategorized those assets. You converted them from cash into a down payment on this property. So now you own this property. This property, when I say you own it, this is very important. Actually, you don't own it. Your retirement account owns it. The owner of this investment property is your retirement account. So the retirement account, your retirement account, put $250,000 as a down payment. Now, that value is in the equity that exists in that building that you just purchased, that is owned by your retirement account. Now, your retirement account also has a mortgage to pay. So those tenants are paying that mortgage every month for you. So every month your equity grows, meaning you own a little bit more of this building every month. And when I say you own it, I want you to remember your retirement account owns it. And your retirement account is getting the so you should purchase this property because there is income above the expenses. So your mortgage is being paid, plus, just say hypothetically, you get $1,000 a month of income. That income is going into your retirement account. So remember, this is an investment inside your retirement account. You are working at your job, making a salary, but that down payment that you made into this apartment building was so great that the equity growth of this property occurs inside your retirement account, and the monthly income also is paid to your retirement account. So what's the benefit of that? Remember that in an IRA, your assets grow tax deferred. So those $1,000 a month that are going into your IRA are going in there with no tax being taken off of it. So we've just magnified the growth inside your account, because the money that goes in there, I'm going to tell you what we're going to do with it, but just fundamentally, $1,000 every month is going in and it's not being taxed. Now, if you were to earn that $1,000 outside of this retirement account, you're going to owe tax on that $1,000. That's income. That's taxable income. But by it being in your retirement account, it's tax deferred income. Your government says to you, hey, thanks for doing that. We're going to defer taking taxes from you right now. We'll wait until you retire, and when you retire and take a little bit out at a time, every time you take a little bit, we will tax you on that little bit. But we will not tax you on that lump sum. We're going to let that lump sum snowball like this. And otherwise, you would have just had a little bit. That snowball would have been smaller. So the snowball would have been this big, and it grows like that. But not taxing it, the snowball starts off this big and it grows bigger. So that's the power of leverage combined with the power of tax deferred growth. And remember, the money's going into your retirement account and it just sits there. We never want money to just sit. So we're going to do one of two things, or two of two things. As the money goes into your account on a monthly basis, we are going to slowly invest that $1,000 into your predefined portfolio. That portfolio was devised based on your financial plan to fit your goals. So we have a portfolio of stocks that we're investing that $1,000 in. However, you are now a real estate investor, not just a stock market investor, not just a bond investor. You're a real estate investor now. So we are going to use that $1,000 a month to build up another fund for a down payment on another property. Maybe we're going to, take 50% and hold that for of that $1,000, so $500, and build up another pot of gold for an investment property down payment, and put the other 500 to use into stocks and bonds, to your stock and bond portfolio, or we'll use the entire amount or some portion, some mix of that. But what we're going to be doing with the $1,000 a month is putting it to use. We're going to invest that. So we're going to invest in the market so that we can grow the funds. And as those funds grow to an amount that equals a down payment on another property, we're going to acquire another property. And then you're going to acquire that other property inside your self-directed IRA, your retirement account. And then we're going to do that same method again. That property is going to cash flow. So you've got two properties that are now funneling $1,000 a piece into your account. We're going to do the same method. We're going to invest a portion or all of it into your portfolio. But best scenario is that we have a separate portfolio for your because the time horizon is going to be different on there. So we've got a separate portfolio of stocks that we're investing in. So let's say we take a portion, 50% into that portfolio, and another 50% into your retirement, into that portfolio that's for your retirement. And as that portion that we're cycling back into your retirement, in for another investment property, once that builds up enough for a down payment, we're going to go out and acquire another property. So now you got three properties in there. So remember, we've always got more than one plan going on at a time. So where we left off in that strategy is that you've got three properties now in your self-directed retirement account. Now, theoretically, each of these properties is cash flowing $1,000. So what we're gonna do, remember, we still have the same strategy. Build up enough for another down payment on another property, acquire that property, put that property into your self-directed account, and collect the cash flow. Build it up. So as we are building up the cash flow, what we're gonna do is take all of that income and we're gonna start dumping it on that first property that you had. So we're going to start smashing that. So remember, that property was $1 million or whatever the amount is, that we're going to start taking that income and doubling up. And what we're going to try to do is double up on the smallest mortgage. So let's say hypothetically we're starting to acquire more and more properties, right? So we've got some income coming in. Now, let's say one of those properties is a $400,000 4 unit property. Well, we've got to the point to we've got $5,000 a month in income. So we're going from all of the properties, including this 400,000. So we're taking the income from that $400,000 property, 4 unit. Oh, this thing need to be quiet. So we're gonna take that income and the income from the other properties, and we're just gonna dump it on one property because we're trying to pay that property off. So let's say that $400,000 one is your lowest mortgage, right? So, or if it's a 100,000, whatever the lowest one, we're gonna try to pay that lowest one off early. And so in the scenario we just laid out, the lowest one has $400,000 in value. Well, let's say that is bringing you, let's say the total rents are 5,000, but it's only cash flowing for you 1,000. Well, if we just smash on that property and pay it off first, well, you've got that whole 5,000 now, plus the 5 that you were getting from the other properties. 1,000 from this one, 1,000 from that one, 1,000, and now we focused our efforts on paying off that one smallest property. So now all of the cash flow is income to me. So we got 5 G's from there plus 5 G's from the other. That's 10 G's. We're gonna put the whole 10 on the next one and try to pay that one off as soon as possible. So 1 or 2 years, you got that whole thing paid off. Maybe not 1 or 2, 2, 3, 4, 5, whatever it is. And then after you got that one paid off, now let's say hypothetically you got another 5 G's from that one. So you got 5 from the first, 5 from the second, because that was the total revenue being made, not the amount that was above your mortgage. But since you don't have a mortgage on those two no more, well, now you can double up on, you got 10 G's plus 5 G's. Now you're going to double up on the next one. And so you're using that strategy at the same time you're using the other strategies to acquire new properties. So you're acquiring new properties and you're doubling up, triple up, quadruple up on one property, trying to pay it off earlier, so to grow the amount of income faster that you have coming in. So those are some of the strategies that you're going to have going on at the same time inside your self-directed IRAs. Now I'm going to smash through it a little faster because we run out of time. I'm gonna cut it in 7 minutes in 30, so it'll be 30 minutes. All right, so that's a convo about credit, leverage, equity and leverage, and your retirement accounts and using the leverage. Leverage is very powerful and can leapfrog your retirement account over others. But I mean, we're not in competition with others, but just over your expectations, over what you thought you were going to be able to do. And so let's talk about I'm just going to cover some bullet points, things we need to think about in terms of financial planning as it relates to real estate investing, and these are important in relation to investing in self-directed IRAs, investing with real estate in self-directed IRAs. So we got to discuss the rent versus own conversation in the first place, right? So I'm assuming that you have already determined that you want to own properties, but this is important to consider in terms of where you live. Rent versus own where you live is a personal decision. It's not a financial one. I mean, it is, but I'm saying you need to own real estate, but I don't care if you own the real estate where you live at, because by owning where you live, you're you're nailing yourself down. So if your life is such that you need that security to own your residence, then by all means do so. But I don't want you to think that you have to do that. That is not necessarily a wise investment decision. But owning real estate is a wise decision. So you have to do that. And if you follow in, our investment philosophies, our we have a program that we call the Hoodoo Portfolio uh, Wizard Wealth Building System, and that system involves investing in real estate within your retirement accounts. So, anyway, so we talked about using leverage, but with real estate inside your IRA, remember you can use creative financing as well. So, owner financing is even better for you. So, if you find someone who owns a building and it could be a burden to them, well, take it off their hands. That person can finance the property for you. You can pay that person uh, and still own the property inside your IRA, but they're the bank for you. So remember that you can use creative financing methods within your self-directed IRA. And um, multi-unit properties are, it's like give you the most bang for your buck inside your retirement account, because you have more doors, more people can pay you. Uh, in the long term, in terms of the financing and the income that is generating, you want to acquire more doors. And in terms of we have a course that is geared around real estate investing, and that course is titled 40 Units in a Mule. And we're attempting to help individuals acquire multi units, and the goal is to acquire 40 doors, 40 units. So we want 40 people paying you monthly income, 40 people paying their rent to you. So that could be 40 individual single family residents, or you might have one apartment building that has 40 units. Point is, we want to acquire as many doors as possible. It just helps the whole strategy of real estate investing to have the more doors that you have. So one other aspect I want to cover really quick is that self-directed IRAs are not just for real estate. All sorts of um, alternative assets can be purchased within your self-directed IRA, but I want to specifically cover crowdfunding. You can use your self-directed IRA to invest in crowdfund opportunities. And as you know, a significant amount of crowdfund opportunities are real estate opportunities, investing in real estate projects. And you yourself may be you may be interested in fixing and flipping. Self-directed IRAs are going to be one of your best friends, because individuals will be able to assist you to invest in your fix and flips, help give you the down payment that you needed. For you don't even have to use your retirement dollars. You can use other people's retirement dollars, and get in other people who have self-directed IRAs can help you fix and flip properties for your self-directed IRA. So this not just crowdfunding, but it's called marketplace lending, also referred to as peer-to-peer lending. So these allow you to syndicate real estate. So um, get syndicates, large groups of investors together to invest in properties for to buy, hold, fix and flip, all sorts of strategies. I also want you to think of other creative financing methods, specifically master lease agreements. Master lease option agreements can be utilized within your retirement account, your self-directed IRA. That's like that's no money down methods. So you basically are wholesaling. Also, you can wholesale properties inside your self-directed IRA account. So the self-directed IRA account type is a mandatory thing for anyone who is serious about becoming a real estate investor. So I'm going to cut it there and just to let you know that I can help you on that. If you need my assistance, if you already have someone you're working with, go tell them, hey, how can you help hook me up with a self-directed IRA, and ask them what you need to do to get started. If you want to work with me, you have to have one of our investment accounts in order to invest in alternative assets. So alternative asset account is a separate account type that is available for our clients. So first off, you would have to be a client. So go to our website, www.hoodoofinancial.com, and open an account. You can send me an email at twhite@hoodoofinancial.com and tell me you want to open an account, and I'll shoot you the link and you can open an account. Just do that. Just contact me and let me know that that's what you want. You can respond. If you're watching this on YouTube, respond right there, in the comments. Tell me what you want, and if I can help you, I will help you. So again, my name is Troy White. Hoodoo Financial. Holla if you need me.